Welcome back to Am I Catching a Falling Knife? The show where we dive deep into stocks making headlines to figure out if they're a potential opportunity or a trap. Today, we're putting Humana, ticker HUM, under the microscope. This stock has seen some turbulence recently, dropping around 10% over the last few days. That's a significant move for a company of Humana's size, and it certainly begs the question, are we seeing a legitimate falling knife here, or is this a chance to pick up a quality company at a discount? Let's find out. All right, let's unpack Humana. First, what's the dominant market narrative currently driving HUM's price action? It all revolves around the company's strategic recalibration of its Medicare Advantage, or MA, business. Humana is shifting its focus to prioritize profitability and margins over sheer membership growth. This means they're anticipating membership losses in 2025 due to shrinking benefits and even exiting certain markets. This strategic pivot, while potentially good for long-term health, is certainly impacting investor sentiment, especially with ongoing concerns about long-term MA profitability and rising medical costs looming large. So, who is Humana exactly? At its core, Humana Inc. is a health and well-being company operating across the United States. They offer a wide range of medical and supplemental benefit plans, with significant contracts with the Centers for Medicare and Medicaid Services, as well as various states for Medicaid and long-term support services. Their business is mainly split between their insurance segment, which brings in a whopping 85.09% of their revenue, and their CenterWell segment, accounting for about 14.91%. They're a big player, serving millions in medical benefit plans and specialty products. Now let's talk about the quantitative impact of this narrative. How do these strategic shifts translate into numbers? We've analyzed the situation, and here's the breakdown. The market's focus is squarely on that MA business recalibration, which is a huge part of their dominant insurance segment. With Humana exiting certain markets and shrinking benefits, leading to anticipated membership losses, we're conservatively estimating an initial 0.75% decline specifically within that insurance segment for the upcoming quarter as these actions kick off. Given that the insurance segment is 85.09% of their total revenue, that 0.75% decline translates to an estimated total company revenue reduction of about 0.64%. Now here's where it gets really interesting. Humana operates on an extremely thin TTM gross margin of just 2.18%. When you have such tight margins, even a small revenue reduction can have a disproportionately larger impact on net earnings. Assuming some operating leverage, meaning operating expenses don't fall as fast as revenue in the short term, we estimate an earnings elasticity of approximately negative 2.0x. So, that negative 0.64% total revenue impact could lead to an estimated 1.3% decline in their quarterly earnings. Our confidence interval for this impact is quite wide, ranging from negative 2.5% to 0%. This reflects the uncertainty around when margin improvements will kick in versus the immediate revenue hit, and the ongoing pressure from rising medical costs, which could further dampen any positive effects. Now let's talk valuation. Our base case discounted cash flow, or DCF analysis, suggests a fair value of around $260.71 per share. However, when we adjust for the current market narrative, factoring in these anticipated membership losses and strategic shifts, that DCF value drops slightly to about $254.19. Compared to today's price of $273.02, both of those suggest the stock might still be a bit ahead of its fair value even after the recent drop. To add another perspective, if we look at a PEG-based fair value, which consider earnings growth, that comes in even lower at $194.47, highlighting a more conservative view. So, what does this mean for our listeners? If you're looking at Humana, our analysis suggests that the market is already pricing in some of these headwinds, bringing the fundamental valuation down. We've identified some potential areas of interest for a buy should the stock continue its downward trajectory, or if you believe the long-term strategy will prove successful. Our custom buy levels to watch are $254, $225, and $200. These are points where the valuation becomes more compelling based on various metrics and our narrative adjustments. So, to wrap things up on Humana, HU is definitely in a period of strategic recalibration for its critical Medicare Advantage business. While the long-term goal is improved profitability, the market is reacting to anticipated short-term membership losses and the immediate pressure on revenue. Our analysis suggests an estimated 1.3% hit to quarterly earnings from these changes. When we factor this into our valuation models, the narrative-adjusted fair value comes in around $254.19. That's a key number to keep in mind, especially considering the current market price is still a bit higher. Remember, folks, this is not financial advice. I'm just Dave, breaking down the numbers and the narrative. You need to do your own research, consult with a qualified financial advisor, and understand your own risk tolerance before making any investment decisions. The market is a wild place, and stocks can always go lower than you expect. Until next time, keep those knives sheathed, or know when to catch them. This is Dave signing off.